Hey there, I was asked to put together this video for you to kind of walk through a $10 million policy for a 50-year-old. Hopefully it makes sense. If you have any questions, don't hesitate to reach out and let us know. But let's start with, a typical $10 million policy. You can do a couple things from a standard standpoint, and none of them are wrong per se. It's just a matter of what it is you're trying to accomplish. So if we were going to focus on term insurance for $10 million, for a 50-year-old, and we started with the 10-year level term, annual premium of $7,000, $230 a year. If we were going to do a 20-year term, $14,000 a year, and a 30-year term would be $27,000 a year. And that's term insurance. And term insurance, is for a very specific period or window of time. It's for a very specific need that has a window, because less than 2% of all term insurance policies ever written have ever paid a death claim, meaning 98% of the policies that have been written, either the term expires, if it's a 10-year term, the person's still alive beyond the 10 years, 20 years, 30 years, or they surrender or cancel, stop making payments, and the policy lapses in a period of time because the insurance is no longer needed. So if you're wanting to just cover a very specific window, that may make sense. But for the vast majority of circumstances, permanent life insurance needs to be part of the conversation. And there's really two different types of permanent life insurance. You can do index universal life, and you can do whole life from a fixed perspective. Index universal life is permanent policy that will allow for overfunding of the premium. So above the cost of insurance, the policy charges fees and expenses. You can put excess premium payments in, which create a cash value. Sticking with the $10 million theme, Lincoln Symetra Allianz, if you were going to fund it for 10 years to try to match the same tax-free distribution that we've created for you in the premium finance design. So to match $413,000 a year of tax-free distributions, you need $323,000, $324,000, or $349,000 a year every year for 10 years. And one of the videos I have, or I can go over with you again, is the 4 arbitrages that exist in premium finance life insurance. And one of the arbitrages is that this premium payment of $323,000 a year is an after-tax premium payment. So money had to have been earned, income taxes had to have been paid to create a pool of money where the $300,000 is sitting there ready to be deployed as a premium payment. Or if that money doesn't exist already, you need to earn a pre-tax amount to pay the taxes to pay the $300,000 a year. Whereas when we do a finance policy, I'll show you how those loans are income tax free. And then on the whole life side, if you're going to match the same potential distribution of around $400,000 a year of tax-free income, New York Life is requiring $526,000 a year of after-tax premium payments, and Mass Mutual is requiring $786,000 of after-tax premium payments. And both of those will generate an IRR in the 5 to 6% range based on premiums paid out of pocket. But when you fast forward to premium financing, if that's the option that we choose, and there's some things that we have to discuss from a premium financing perspective. Premium financing provides an opportunity to create leverage, as long as we understand leverage. So in this particular policy, 6.65% is the illustrated crediting rate, and $819,000 a year is the premium that is suggested / required by the insurance company to maximize those distributions, to maximize those contributions going into the policy from a most efficient contract to create the most cash value into the policy with the most potential growth available to it. So policy or columns 3, 4, 5, 6, and 7 are from the insurance company. Policy premium, policy value, cash surrender value, and gross death benefit. And you'll see that we're starting with the $10 million death benefit, and we're adding the policy value to that in column 7, and that's why it's an increasing number in column 7. The death benefit keeps getting larger and larger and larger. Columns 8, 9, 10, 11, 12, 13 are bank lending information. This is where we're going to introduce the financing, the leverage to the design. So instead of the client, you paying $819,000 a year, we're going to have a bank finance the $819,000 a year. And the banks that we use provide financing with no personal guarantee, limited guarantee, non-recourse lending. Here we've got the projected interest rate just from an illustrative perspective, and then we've got the total amount of interest due on the outstanding balance. And in column 12, we have you making an out-of-pocket payment of $78,000 a year. So the way the math would work is the premium is borrowed plus the interest is borrowed minus what we're projecting you pay $78,000 a year for 10 years. That's a far cry from $300,000 a year for 10 years, equals an outstanding loan balance. And this is that non-personal guarantee, non-recourse amount. And when you do the math, add up the premium plus the interest minus the payment, we get an outstanding loan balance. And the bank is going to take a position of collateral of the cash surrender value of the policy. So in year one, that cash surrender value is $258,000. So we have $786,000 of an outstanding non-personal guarantee, non-recourse outstanding loan balance, minus $258,000 leaves a gap of $527, a shortfall of $527,000. And the projection in this illustration, based on the illustrated rate used and the loan interest rate, the peak collateral gets up to $530,000. And then what happens is that gap starts to narrow because the cash value is getting larger in the design and catching up to the outstanding loan balance. And at some point in the future, when the cash value is larger than the outstanding loan balance, then there's no longer any additional gap collateral that's required to be pledged. The bank is fully collateralized by the cash value of the policy. At some point in the future, we show you exiting the loan by taking the money from the life insurance policy to exit the loan and create a tax-free distribution for you of $413,000 a year, income tax-free for the rest of your life, while also maintaining as close to a $10 million initial death benefit as possible. So this is just an initial, explainer video to help you understand what it is that you're looking at. Obviously, this needs to be tweaked, this needs to be adjusted, and then there should be additional stress testing that's provided on this. But as a starting point, this is a good place to begin. Hope you found this helpful. Thank you.